a big part of my work and a big part of the talks that I give around the country, came around the time that I wrote my first book called Permission to Spend, which I published a few years ago. And the whole idea of that book is not it's not to necessarily share anything brand new to the industry, but it's meant to be a tool for advisors to use with their clients, which talks, it's basically retirement planning 101, is what the book is. But it finishes with a discussion around using annuities, using life insurance, using actuarial science in concert with other traditional investments.
Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future. Welcome to Sterling Insights, Stand Out and Supercharge Your Assets. I'm your host, Roger Silk, and with us today is Tom Wall. Tom is a leading expert in whole life insurance and retirement income planning. Tom is perhaps the first person who I've talked to who holds a PhD in retirement planning, and he has a best-selling book. The title is Permission to Spend, and rather than me try to tell you about that, we'll ask Tom about that. Tom works with advisors, helping them rethink life insurance and whole life in particular as a tool for wealth building and wealth preservation. So get ready for some expert insights on tax efficient strategies and maximizing your clients' assets. Thank you for joining us, Tom.
Thanks for having me, Roger. Good to be with you.
I appreciate it. So I do have to ask you about the PhD. Can you tell me a little bit about that?
Yeah. Well, gosh, I've been in the business 22 years now. Several of them were as an advisor before taking a number of sales and leadership roles at one of the major mutual home offices. During that process, continue the process of education as I'm standing in front of advisors. One of those roles being a wholesaler, standing in front of advisors and coaching them on various strategies and suggesting that this product actually made a lot of sense. I wanted to actually dig in and see if that was true, or if it was just a good sales pitch for something you probably didn't have to apologize for. So, after years of just one course at a time, while in hotels 100 nights a year on the road, I was chipping away at various degrees and actually ended up with a PhD in retirement income planning from the American College so my studies were actually under Wade Pfau, who is maybe the expert in retirement income planning, if we were to name one. I was very blessed in that way. I got exposed to a lot of really great research and literature and was able to create some of my own along the way.
Did you write a PhD dissertation?
I did. It was actually whole life as a fixed income alternative in retirement, trying to test if that made sense.
Can you give us the high-level overview of what questions you asked and how you went about answering them and what answers you came up with?
Sure. I mean, the main question was, did it actually make sense as a fixed income alternative? I had spent the majority of my career hearing advisors position it that way, basically whole life as a bond alternative. And the thought process behind that is the general investment account of these major mutuals, that are paying dividend paying or offering dividend paying whole life insurance. Their general investment account is essentially a giant bond fund. They tend to have some other holdings in there that augment those results, but that's essentially the thought process. So I wanted to test if that made sense. And along the way, I basically found that over a period of time with life insurance, there are a lot of upfront charges, and it's not just commissions. A lot of people throw stones at the life insurance space, thinking it's just this commission-driven thing, and that's why you don't get much return in the early years. There's a lot that goes into issuing these contracts, like legal departments, marketing departments, actuaries, sales teams, all that stuff. But on a long enough time frame, if you hold on to it for 5, 10 years and beyond, it starts to perform very much like long-term corporate bonds because that's the favorite investment of these big mutuals underlying the performance, but with none of the volatility or risk. The insurance contract essentially indemnifies you from any of those risks. It guarantees that cash values must rise every year. The only question is how much do they enhance that rise, with the non-guaranteed dividend. So my question is did that hold up historically? And it did once you allowed that life insurance policy to bake for a little bit. If the investor has that kind of patience to do that, then usually around the 10-year mark, give or take, depending on the design of the policy, you start to see that you have a contract that's giving you bond-like returns, but no potential for loss. And for me, I think as I've looked at the investment world, that's kind of the holy grail is improving that Sharpe ratio. It's not just taking a bunch of risk for absolute highest returns. It's how much of a return are we getting relative to the risk we're taking. So if you can find a sliver of your portfolio, and in this case, it's the fixed income piece, and optimize it in such a way where you're getting tax advantages, you're getting guaranteed growth and similar performance over time, that actually can provide better outcomes.
And were you able to obtain data from the several mutual companies and actually look at the performance of real world policies?
Yeah, so there was actually a data set that I used, from a major mutual it was a policy issued in 1980. It's a struggle getting historical data from a lot of these companies because A, they may not have it. If they do have it, they would have to actually pay their actuarial team to go back and recreate a policy hypothetically from far earlier in the century. And the thing about that is that's not necessarily relevant moving forward. The insurance, there was no such thing as a preferred health rating, prior to the early 1980s. So at this point in time, it was like, do you smoke or do you not? Actuarial tables were different, commission structures were different. So that was the biggest challenge of it. But there was some relatively modern data that I used that I think, told the story, at least for that case study.
And so you were looking at the period, maybe what, 1980 till you said you did this in the mid 90s?
No, 1980 to today. So it was about a 40-year study.
Oh, okay. When did you get, you said you got your PhD 20 something years ago?
No, I started in the business 22 years ago. The PhD, I think I wrapped up 4 or 5 years ago.
Oh, okay. I misunderstood. I'm glad you clarified that. So you had like close to 40 years of data.
Yeah.
And if you, I mean, is were they like the 10 year, like the 30 year? What were they like?
When you say what were they like, what do you mean by that?
Well, as a substitute, if we're going to use, obviously we're looking at this historical period, but if somebody has bonds in a portfolio and they're thinking about instead, how do they compare? I guess is really what I'm asking you.
Well, that was actually the hardest part of the study. Like making that comparison is difficult because whole life insurance isn't a bond, it's a contract. It's not a security, it's a contract. So in many cases, it's a decade before you even break even relative to what you've paid in versus what you get out. So I think for a lot of folks that's a struggle. It's hard to make that comparison because of all the expenses inside those contracts tend to be front loaded. The insurance company's paying for all those things I just talked about. But usually by around that period of time after that funding phase, if a company is paying a full stated dividend interest rate of say 6%, you're typically getting most of it, depending on the design of the contract. You're probably getting 80 to 90% of that in terms of net actual return in your contract. So I always say that one of the hurdles to get into this stuff is there's really two big hurdles. One is you got to be healthy enough to own it. These are medically underwritten contracts. But the second one is, there is that funding phase. The IRS, with their 7-pay test and the MEC thresholds, they've kind of forced us into an environment where the premiums to get into these things have to be spread out over a certain period of time. There's no specific data point that I can point at, but that's essentially where all the research went to is over a long enough period of time. Once you get past those early years, it's basically bond-like performance. That the dividend interest rate is effectively a rolling average of the long end of the yield curve because that's how these insurance companies invest in long duration corporate bonds, but with no volatility, with absolutely no volatility. And unlike a 401k or a typical retirement plan that has a lot of strings attached around contribution levels and 59 and a half rules and RMDs, all the things that go into an ERISA qualified plan. None of those strings are really attached to a whole life insurance policy. So for healthy people with a little bit of a runway to get these funded, it can be very attractive to diversify from a risk standpoint and a tax standpoint. And the third one I think a lot of people forget is access, just being fully accessible along the way, either defensively or for opportunities that pop up.
So, what's the prime? Who does it work best for? Like what age? Presumably healthy.
It works for anyone, but if there's if there's that perfect conversation that I think a lot of advisors may be missing is that the mass affluent 45 to 55-year-old, who can see retirement a little bit, and they're starting to think about how they traditionally will start to take a little bit of risk off the table as they get closer to their goal. By incorporating this as part of their fixed income piece, they may be able to stay more fully invested with the rest of their assets, which is really what we're trying to do, is stay invested as long as possible to maximize those outcomes and play the long end of that compound interest curve. So I think those are the individuals who are really looking to reallocate some assets and build that strategic piece of their portfolio. But it can be older than that. It doesn't have to be that young.
Okay, so if we took just a hypothetical idealized, say 50-year-old,
Hmm.
and I mean, you must deal with these. So if mass affluent is somebody and somebody like that has roughly, what would you say that person would have in a retirement plan? What would you just,
Doesn't have to be a ton, but a 50-year-old making, a six-figure income, maybe $1 million net worth if you include the value of their home and everything.
uh-huh,
That's I think obviously we all want to talk to ultra high net worth folks, but I think that's kind of the sweet spot for where it fits really well. And there tends to be some excess capital that they can,
uh-huh.
apply to a strategy.
So you'd have somebody like that, and I'm not trying to put words in your mouth. I'm just trying to understand where this fits. So somebody like
Sure.
that, let's say he has $300,000 in a 401k and he's funding it, whatever he does. Would you then think that, okay, that 401k can be all equities and we'll take another, I don't know how much like premium, is that what we would be talking in terms of additional
Yeah.
savings that he would, and like what would a typical case for the hypothetical person that would take 50-year-old would take this much premium, fund a whole life policy, and he would expect to have what kind of outcomes?
It's a great question. I've struggled with that question my entire career, which is a big part of the research. I think I like to think about it differently with beginning with the end in mind. So generally speaking, my recommendation to somebody from a retirement income planning standpoint would be to target 15 to 25% of your overall portfolio in an asset that is not correlated at all with the market, which is whole life insurance. It must go up in value. The only question is how fast. And the reason for that is because if you're taking 5 or 6% of your assets as a withdrawal each year, that provides you with 3 to 4 years in most cases of buffer income, basically income that you can pull from a portion of your portfolio that is going to be rising on a year by year basis. So that if you retire in a year like 2000, where 2000 was a down year, 2001 was a worse down year, 2002 was an even worse down year, your income stays flat and you can stay invested to ride that wave back up when it eventually does start to recover from the market. Whereas if all you have is an investment portfolio, even if it's diversified, there's absolutely no guarantee that your whole portfolio won't be going down at the same time. Like 2022, we saw bonds losing record dollar amounts as the treasury went from 1% to 4% in the course of a year.
Mhm.
Equities were down. Real estate was struggling. Bitcoin, if you're invested in that, I mean, even crypto was struggling during that year. So when everything is struggling, which tends to happen when there's geopolitical risk or some kind of world event, to have a portion of your asset that must go up makes a lot of sense. And by the way, this is not my strategy. This has been used forever. There's entire books written on using home equity through reverse mortgages. The traditional investment community will just quite literally use cash, just have cash on hand as their buffer asset. But when you start to understand the long-term economics of these major mutual dividend-paying participating life insurance policies, you start to realize that you can get far better returns than you will in cash with similar liquidity after you've kind of built that bank and bond-like returns. So if you can get a better risk profile and similar returns and access along the way, it is a better asset than just about any alternative for that purpose.
So basically and I'm not trying to put words in your mouth, I'm just trying to see if I understand this. So if
Sure.
somebody takes, and I don't know what's a reasonable number, 10,000 a year, 20,000 a year, what's a common premium that you would see on one of these whole life that the person, I guess, is going to pay for indefinitely or 7 years or what?
You can build them anyway. So most companies will offer a 10 pay design or like a 10-year payment kind of, and those are usually overfunded, truncated designs. I I throw out there a break even year of usually between year 9 or 10 is a break even on those overfunded designs.
Uh-huh.
So
So
again,
someone would take, say they want to put in X, what would X be? In the kind of case where the guy has $1 million net worth of 50, what would be a typical X that he's going to aim for to fund over the next 10 years?
yeah, good example is so let's say forget about today. I would think about the projection. Let's say the projection is that they're going to have $2 million in investable assets at retirement. If I'm targeting 20% in whole life cash value performing that way, then that's 400,000. Divide that by 10, that's 40,000 per year. So uh, the mind shift is not a $40,000 premium payment out of your after-tax income that comes into your pocket. It's more of a reallocation of assets. That individual will typically have, some kind of liquid savings, or they may be funding outside of their 401k, non-qualified investments. This is basically an alternative to those things, not necessarily a replacement for, other more traditional retirement savings.
And so if wherever it's coming from, and there's 40 a year going in during that kind of run up period, is there any cash value there or not very much?
Yeah, absolutely. Usually you lose about a year of premium in the early years. So, in year two, you've paid an 80, you might have 40, which I think is what turns most people off of whole life. They think that's a bad deal. But I liken it to closing costs on a home. Like everyone knows, owning a home is a good proposition over a long period of time, but it's probably not a great idea to buy a house and then move 18 months later. You're going to lose in that transaction. So it's very
Uh-huh.
similar here too. You're effectively
Right.
just kind of prepaying a lifetime of insurance. And we haven't even talked about the death benefit piece yet. That's really the main goal of owning this stuff too, at the end of the day.
Does somebody have to have a need for the death benefit, or does this make sense? Even if, like, let's say there are no kids or the person is single and has no dependents, would it still make sense from an investment point of view, a retirement point of view?
Yeah, it's a great question. So I think yes, I think the economics have gotten so good on these lately because of the rate environment that we're in. You got to think when you put money into these things, it's always relative to what else you can do with your money. And from a low rate environment where we're at right now, everyone I think a lot of the world was shocked in 2022 that bonds will not be what they were for the last 40 years. I mean, bonds were the perfect diversifier for equities as interest rates fell for 40 years straight. Because as interest rates fall, bond prices go up. So bonds have just done unbelievably well, like we've never seen in history over this last 40 years when our financial planning world and all the rules around it were built. So I think that kind of answers the question. It's not so much a replacement for, although some people will go that far. I think it's more of a diversifier for that piece of the portfolio. And that's how you got to think about it. If you don't love anybody else in this world, you have no need for life insurance or no desire for life insurance. I still think some of these overfunded designs, based on some of the new rules that came out a few years ago on how they're built, it can still be a very attractive alternative. But I think most of the mass affluent crowd that we deal with do love other people. At the very least, they're obligated to their spouse to make sure there's money left over for them, upon their death. And that's the crux of my book, The Permission to Spend, is all the stuff I just said about it being a great bond alternative is true. I view permanent death benefit more as a backstop to a retirement plan because if I know that my kids are going to receive a legacy, I know that my spouse is taken care of, I know that there's a liquid or accessible pot of money that I can tap into outside of market forces. And some of these contracts now have modern long-term care riders. So you can actually use those death benefits while you're alive to pay for long-term care. When you take a lot of those risks off the table, I think people will feel far more comfortable to either spend their assets or at the very least stay more invested in the market, which every study ever done has shown the longer you can remain invested in the market, the better outcomes you'll have.
Uh-huh. So setting aside the death benefit, the investment case, if I'm hearing you right, is basically that over the long run, this is a very low volatility, like next to no volatility, because the only volatility is really going to be your how much your dividend is going to vary, right?
Yeah. Yeah, long term your internal rate of return will be 5 to 7%.
What about credit risk?
Yeah, I mean the insurance company effectively insulates you from credit risk. The general investment account of these insurance companies are spread across hundreds of holdings. So hundreds of bond issues from the biggest corporations, most highly rated corporations around the world. So individually, there is credit risk to the insurer, where a portion of their portfolio, could that bond could default. But from my research, that's typically no a bond the bond holding the largest bond holding of these major insurers typically doesn't exceed more than 0.1 or 0.2% of the entire portfolio. So it's very, very minimal in terms of credit risk.
What's the exposure to the company itself? Like if the company itself got into trouble, the insurance
Well,
company.
if the company, I mean, at the end of the day, the insurance contract is backed by the guarantee of the insurer. So if the insurer were to go under, there are state-based guarantee institutions. It's not FDIC insurance, but it's if there's something akin to it, it's that where at the state level, the insurance guarantee organization will step in and effectively make policy owners whole up to a certain amount.
So do you find that advisors you work with or their clients, do they differentiate between, say, the Mass Mutuals, Northwestern Mutuals of the world? They're like the companies that have been around for 150 years with, super
Mhm.
long track records and presumably the best credit going forward. Do they differentiate between those and maybe some company that's a lot less familiar?
Oh, 100%. Yeah. I mean, what I'm talking about is basically contracts issued by those big institutions that, have been paying dividends to policy owners since Civil War times. These contracts actually get almost a bad rap as like these old stodgy things of the past, but
Uh-huh.
that's where it fits. That's what they're supposed to be inside of a portfolio so that you can take the risks on the new sexier investments. There's a lot of insurance companies that don't even offer whole life insurance because it's very hard to build that portfolio and have it perform well against the big 300, 800-pound gorillas that have been around forever. So you'll tend to find index universal life or variable universal life or a lot of these other options for permanent life insurance that, in my opinion, they just don't offer nearly the same value prop as whole life does.
Right. And just for people who are listening or watching who aren't totally familiar with all the language,
Mhm.
what you're talking about is described as, is it traditional whole life? I'm not trying to put words. I'm just trying to, as you also mentioned, variable universal and something else that I don't remember what it was.
Yeah, I mean it's dividend paying participating whole life insurance. So whole life, I've heard whole life used as a name to describe a lot of permanent life insurance policies inappropriately, but I'm talking about whole life insurance issued by a major mutual company, mutual meaning that it's operating for the benefit of its policy owners, not shareholders.
And how many of
That
those companies are there, Tom?
I don't know the number, honestly. Of the big ones that I would typically recommend, probably five or
Mhm.
six. There's certainly more than that, probably about 15 or 20 that are, A rated, A plus rated that have been, but they get much smaller, much very quickly after you go past those big mutuals.
Okay. And how do you work? Do you primarily work with advisors, Tom?
Yeah, so I do a few different things. I am on a plane almost every week. I do keynote talks throughout the industry to rooms full of advisors. I actually just hosted my first live event in Florida last week called the
Oh,
Fast Start Florida.
congratulations.
Yeah, it was a big success. But I also host a group called Whole Life Masterminds, which is we have I think 1,400 registered users right now. We do biweekly Zoom calls with upwards of 500 people per call, and they tend to be protection first advisors from these major mutuals looking for ways to position this with their clients, help them understand it, as such, I do a lot of training myself, or connect and bring in top thought leaders in the space like Wade Pfau or some other well-known names and top 1% advisors that share, their success stories and their strategies that have worked.
So if an advisor wanted to take advantage of your knowledge and your connect, what would be the ways for an advisor to do that?
Well, I always say follow me on LinkedIn. I tend to post a lot of content there. Wholelifemasterminds.com will give you an overview of the program, and that's the easiest way to get plugged in. It's very inexpensive. If you find one good idea, it pays for the whole thing. It introduces you to a community of other like-minded folks that are talking the talk in this way. I think the biggest struggle for advisors and really forget about advisors. The financial services marketplace in general is all built around gathering assets, building assets, investing well, and getting to some retirement number, whether that's $1 million or $5 million, whatever your number is. And the conversation for a lot of folks stops there. When really, I think that's commoditized at this point. I think you can do most of that yourself as long as you're saving enough money and you're not doing anything real stupid. You can accumulate wealth on your own. I really think the art for advisors is helping build plans in a way where someone can efficiently and maybe even a little bit aggressively spend those assets down in retirement and like maximize the enjoyment of those assets. If people are only having conversations about an investment portfolio, then you show up at retirement with all these millions of dollars, but now you're not going to ever earn income again, and you're terrified to spend it because you don't know if there's a major market crash coming. You don't know if there's inflation. You don't know if you're going to live 60 years after your retirement date. There's just so many unknowns that retirees are like successful retirees are hoarding their wealth these days in relatively tax inefficient accounts because they're terrified to spend. So for me, it's less about whole life rates of return versus something else. It's more about a strategic allocation that gives you permission to spend your assets, which is why I titled the book that way. And that's a lot
Right.
of what we talk.
So whole life masterminds is just give us a little bit more flavor of what it is, how it works, who it's for.
Yeah, so I unapologetically called it whole life masterminds instead of life insurance masterminds. It's very focused on this specific product by these companies. And I call myself biased unapologetically because I'm professionally biased. I've kind of done the work on it. So what we do is as a group, we meet every other week, so 26 times a year, every other Wednesday. And about a third of the time, I'm doing deep dive concepts on some of my research on how to employ those buffer strategies, how to compete with other options out there, and my best language that I've picked up working with advisors over the years. And then the other 2/3 of the time, like I said, I'm bringing in thought leaders in the space, some of the most prolific authors in the retirement income space, like a David Blanchett or Wade Pfau, and then mixing in top 1% advisors, advisors with seven-figure life insurance practices, talking about how they position it, the exact strategies that they'll use with certain sets of clients. Some of them will have unique niches, like a premium finance expert for the ultra high net worth. We'll have them in there sharing how they approach their clients. So the idea is just to create an environment where you're always exposed to, the best in the business and a community where you can, share ideas amongst yourself. Whereas I have found the industry tends to be a little bit insular, where these insurance companies will kind of operate among themselves, but advisors won't share between each other across the industry. And that's a miss. I think it's a miss for clients.
So I think you said you have 1,400 members. Is that what you said about right now in masterminds?
That's right. Yep.
And I'm guessing that there are people who are primarily life insurance focused there and also people who are primarily asset management focused. Is that right?
Yeah, it's actually a pretty experienced group. The ones I find that get the most out of it tend to be what I call the rising leader. They've proven that they're not going to starve in this business. They have a successful practice and they're looking to just get new ideas and keep growing and pour gas on the fire and just accelerate their growth. But I've also found and this is really what got me to start this, is over the course of my 22 years, I've watched the support go down for these advisors from the major carriers and with it at the agency level. But I've also noticed a lot of distraction. Well, the advisors today have to be generalists. They have to know about legal issues, tax issues, how to be a financial planner, how to manage investments. They need to know about insurance. And all of that stuff tends to crowd out some of the core conversations that, from what I've seen, has really built the industry decades ago. So for me, it's really just a way to get refocused around some of the core principles,
So would
which
the members who it appeals to be mostly life insurance professionals?
it tends to be full-fledged financial advisors who
So,
have life insurance as part of their offering.
Okay. So it could be a guy who's managing $200 million of assets under management, but is also very savvy in the life insurance arena. Is that fair?
100%. I don't think we have any members that only focus on life insurance.
Okay.
Oh, it
Um,
is, but it's in the context of broader financial planning for sure.
Not everyone who talks like that actually does that.
Hmm.
But you're talking about advisors who are, and I think you just said this, kind of at a higher level than the typical advisor. What's the demographic of the members? If people are saying, "Oh, I'm interested here. I'm 30, I want to be the youngest guy in the room," or "I'm 70, I don't want to be the oldest guy."
Well, with a room as large as I described, you'd imagine there's all kinds. I have 30-year veterans making 5 million a year that get a lot of value out of it, and I have 30-day veterans who are still trying to figure this whole thing out. So there's really something for everybody. But I think the person I would say to get the most out of it is, like I said, that rising leader in the business. I don't want to put a number of years on it, but 5 to 15 years in the business, they're starting to see some real success and just looking for bigger, better strategies. And also the asset managers, the ones who kind of believe in those core principles but have gotten away from it, just managing the book and building up their hundreds of millions under management. They're finding ways to actually give their clients better outcomes, better tax advantages than they're otherwise able to do, and reposition assets in ways that lead to better client outcomes.
Tom, with all your success, what would you say is the biggest challenge that you're facing right now?
Biggest challenge, I think the biggest challenge this part of the market that I'm serving is facing is a lot of the misinformation online. There's a lot of talking heads that would tell you whole life insurance is bad, which is kind of it's like saying cars are bad. Like that's a ridiculous statement. It's such a broad world and so many different flavors and ways to set it up. I think when the typical consumer hears that, they get a recommendation from an advisor and they Google it and there's article after article saying this is a scam or this doesn't make a whole lot of sense. It stops them from actually making the decision to buy and actually implement the strategies, which are sound. They are academically sound. I can attest to that, having done the work. And for me, that's the biggest headwind is there's more and more misinformation out there. And who do you trust? And typically the people with the biggest followings get the most trust, even though that's not necessarily where that trust should come from.
I know we only have a half an hour. Is there something particular that you'd like to talk about that we haven't had a chance to talk about yet?
I would say a big part of my work and a big part of the talks that I give around the country came around the time that I wrote my first book called Permission to Spend, which I published a few years ago. And the whole idea of that book is not to necessarily share anything brand new to the industry, but it's meant to be a tool for advisors to use with their clients. It's basically retirement planning 101, is what the book is. But it finishes with a discussion around using annuities, using life insurance, using actuarial science in concert with other traditional investments as a way to maximize your ability to spend in retirement, shift risk, and give yourself comfort. The book opens with, you will be afraid to spend in retirement. And you will, even if you have millions of dollars, you will be terrified to spend that because those are the last dollars you're going to earn. So it's all about helping clients understand that it's not this or that, it's this and that, and finding ways to kind of build those assets together. So I would invite people to, it's a very quick read. Check it out on Amazon. It's available in all formats, or permissiontospend.com for advisors. Sometimes you can order a box of books and send them to your clients. I have a number of advisors that do that. And it's helping open up conversations and give some objective third-party data and discussion around these topics, as opposed to just articles online that may or may not apply to that specific situation.
I appreciate that. Where can our audience go to learn more about you? You can give us as many contact points as you want, and we'll also put them in the notes.
Yeah, so if you're an advisor and you're looking to kind of level up your practice or get more involved in this, wholelifemasterminds.com would be a great place to find me there. Permissiontospend.com is more the consumer side. So if you're looking for the book or ways to engage with clients that way. I'm also at tomwalltalks.com. If you happen to be a firm leader that might want to hire me to speak and have me come in and work with your team, I do that on a weekly basis all over the country.
Great. Thank you so much. I really appreciate it.
Thanks for having me. This is great.
Thank you for listening to another episode of Sterling Insights. Stand out and supercharge your assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts Roger and Catherine Silk invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.